Now, to finish up this unit on, well, this part of stockholders' equity, the next thing we really need to consider is dividends. Now, when we talk about dividends, what a dividend is simply the allocation of the company's earnings to their stockholders. Several different instances exist where we would pay a dividend, but keep in mind a company can only pay a dividend if they have retained earnings. You cannot make retained earnings go negative through a dividend. And in theory, they should have enough cash or the asset they're giving out to cover the dividend that they're passing out. Now, typically when we talk about dividends, there's three types. There's cash dividends, there's property dividends, and then there's stock dividends. Cash dividends, as the name implies, simply means we're going to pay a cash dividend. This is the most common that you see in the marketplace. So you'll say here a company declares a dividend of. That's what they're typically talking about is a cash dividend. And they are the most common. Most companies, or a lot of companies, not all, but most do pay out cash dividends at some point in their lifespan. It is optional for a company to pay a dividend. They do not have to. But when we're talking about cash dividends, we simply pay the cash that we owe to the individual shareholders. Property dividends allows for the company to give out any asset they so choose to the owner. They can give out land, they can give out buildings, not very common, or they could give out investments. Say they bought stock in another company, they can give that stock to their stockholders as a property dividend. Those are not quite as common as the other types, but they do exist. And then the final is the stock dividend. And a stock dividend, as the name implies, instead of giving cash or property, we actually give out more shares of stock to our members. Now, when we talk about dividends, there's really three dates of primary importance. The date of declaration, that's the date in which the board comes out and declares we're paying a dividend. There's the date of record. That's the date on which we get the list of names to pay the dividend to. So whoever owns the stock on that date gets the dividend. And then finally is the date of payment or date of distribution. And that's the day we pay out the dividend, either in cash or in more shares of stock or whatever property we guaranteed our owners. So again, there's three dates of importance: the date of declaration, the date of record, and the date of distribution or payment. Now, a lot of people want to say, ooh, date of record, that's when I record it. No, absolutely not. Because on the date of declaration, that's the first date in the dividend's life. That's when a liability is created for our company. So that is very important from a financial accounting standpoint. At that point, we must record that dividend. Then, the date of record, while it's important, it does not typically create a journalizable event because it's just giving us the names of the people we're paying out. So the date of declaration gives us the payable, the debt, so to speak. The date of record tells us who we pay that debt to. And then finally, date of distribution definitely impacts financial statements because that's the date we actually pay it out. So of those, all three are very important, but the two that typically impact the financial position of the company are going to be the date of declaration and then the actual date of distribution or payment. All right, so let's look at some transactions here because I know that's what you're really wanting to see in this video is how do we actually record or understand these concepts. So listed below the transactions that affected shareholders' equity of Branch Rickey Corporation during the period of 2018 through 2020. At December 31st, 2017, the corporation's accounts included the following. They had common stock that had 105 million shares at $1 par, 105 million. So again, remember stock is carried at par. So even if they had not told us that, let's just say that this is all they told us. Common stock at $1 per pair. Per pair, listen at me. Excuse me. Common stock at $1 par. When we look at that, we know, well, wait, there's 105 million here at $1 par, so that means we did 105 million shares. So even if it had not told us this little bit right here, we could have deducted it from the balance in the account. And then paid in excess of par there is our 630 and retained earnings is 970. Technically speaking, we are not allowed to give a dividend that exceeds that 970. If we do, well, we really can't. We can because a dividend is an allocation of earnings, so you can't allocate more than you have. Now, keep in mind, the company can report a net loss for that year and still pay a dividend, assuming they have enough cash to cover it and they have retained earnings balance to cover it. So even though a company maybe lost money and you're like, well, wait a minute, they're losing money, how are they still paying out a dividend? It's entirely possible if they have retained earnings that'll cover it and they have enough cash to cover it. They're still able to pay dividends even in times of losses or periods of losses. All right, November 1st, 2018, the Board of Directors declared a cash dividend of 80 cents per share on its common shares payable to shareholders of record November 15th to be paid December 1st. There's our three dates of importance. Date of declaration, November 1st. That's the day the board has declared this dividend. What type of dividend are we giving? A cash dividend. Then the date of record is November 15th. That's the date we get the information for who to pay. And then finally, December 1st is when we're actually going to pay it. Since it's a cash dividend, that's the date we actually pay cash. So really, the two dates that are going to create events for our financial accounting entries here would be November 1st and December 1st. Now keep in mind, again, we're doing these entries in General Journal. Not all entries go in General Journal. This is just so we can sort of understand what is the impact of our overall financial position for our company. All right, so let's look at this. Well, November 1st is date of record. What would we record? Well, there's a couple of things here really you can record. You can either hit, some books will teach it as cash dividends. If you do use a cash dividends account, then you have to close it to retained earnings later. And some textbooks say, hey, go straight into retained earnings. We're going to go straight into retained earnings. That's because that's the book we use. Remember, a dividend is the allocation of retained earnings of the company, the allocation of earnings to the shareholders. So we're reducing our held earnings and we're giving those earnings out to our actual shareholders. Okay? Now, how much? Well, it says we have 80 cents on per share here. There we go, 80 cents per share. Now, that is outstanding shares. So when we talk about stock, we have we've got authorized, that's what we're allowed to sell. This doesn't tell us what we're authorized at all. I don't know how many shares I'm allowed to sell. We have issued, it tells us we have 105 million issued. It doesn't tell us how many is outstanding, but outstanding shares are shares that have been issued minus any treasury shares. So in this problem, the only way my issued would not be 105 is if I came down here and said, hey, we had treasury stock. Let me align that left so we can, oh, I'm in the wrong cell. Go over here, right there. Anyway, there we go. If we come in here and we had treasury stock, if we have treasury stock, and let's say we had 5 million shares, if that's the case, then we would use 100 million because treasury shares reduce our outstanding shares. This problem, we have no treasury shares, so we don't have to worry about that. But keep in mind, if you ever work a problem that does have those treasury shares in there, you have to back those out before you do the multiplication. Here, we're just simply going to take the 105 million, times the 80 cents per share, and that's going to give us 84 million. Now, you can type it out like they would, or you can type the full amount. I'm just going to show the full amount just so that we realize it's full 84 million. Now, where does that go? Well, remember, this is date of declaration. We're not paying it out yet, so we're going to hit cash dividends payable for that 84 million. Now, some books will just say dividends payable, and that's perfectly fine. I always base it off the book that I'm using at the time of the video, so keep in mind that may be a little different from the textbook, but cash dividends payable would be what we would hit. Now, moving forward on this one, November 15th is our date of record. Well, November 15th, we would actually have no entry. While it is very important that date, it doesn't create any type of change in our financial position. It simply gives us the list of names that we have to pay that 84. I say simply, but that's what it is. It's going to give us who we actually have to pay that dividend to, because if you hold the stock at that point in time on that date, you get the dividend. You may not have held it yesterday, you may sell it tomorrow, but if you hold it as of the date of record, you get the dividend. So it's important, but it doesn't really change the financial position of the company. All right, and then December 1st, we're going to change our financial position because that's the date we're paying it out. So on the date we pay it out, we're going to hit that cash dividends payable because once we pay it out, we no longer owe the funds. So we're going to hit that cash dividends payable for the 84 million. And then we're going to go in and, well, it's a cash dividend, so what are we going to give our shareholders? Well, we're going to give them cash. A lot of people hit cash dividends again here, and that makes absolutely no sense. Don't do that. You're paying out cash. You're writing them a check, so to speak. Now, it's going to be electronic funds. Typically, I don't think we would write, you have 1 million stockholders. I don't think we're going to write 1 million different checks. But it's still coming out of cash, whether it's electronic transfer or whether we actually pay them cash or write a check. It's all coming out of our cash account. All right, so that's basics of cash dividends. Let's continue on. March 1st, the board of directors declared a property dividend. So here's our second type of dividends we discussed, consisting of corporate bonds of Warner Corporation that Branch Rickey was holding as an investment. So in other words, BR, let's just call them BR, had purchased these bonds and they're holding them as an investment. Now they've decided to, hey, let's give these bonds to our shareholders. The bonds had a fair value of $1.6 million, but were purchased 2 years previously for $1.3 million. Because they were intended to be held to maturity, the bonds had not been previously written up. That goes all the way back to the investment chapter. This is an HTM, is what we always call them, held to maturity. We always carry those at their amortized costs. And if we paid the actual fair value at the time, 1.6, if that, or excuse me, 1.3, then that would be the value still sitting on our books for HTM. It wouldn't actually have been marked up to fair value yet. The property dividend was payable to shareholders record March 13 and distributed April 5th. There again, there's your 3 dates of importance. March 1st is our date of declaration. March 13th is going to be our date of record, and April 5th would be our date of payment or distribution. Same as before, 2 dates we create our entries for us here, March 1st and then April 5th. So let's go through those and see what we would do. What would we do on March 1st? Well, there's a couple of things we have to do on March 1st. First and foremost, on the date we declare the dividend, we have to mark the position to fair value. So what does that mean? Well, we purchased it for 1.3. So that's what the investment is currently on our books. It needs to be marked to 1.6. So do I need to increase or decrease my investment? Well, I need to increase it from 1.3 to 1.6. Well, investments are assets. So to increase an investment, I would go in and debit my investment in bonds. Some books are a little more specific. It'll say Warner bonds, so that's really up to you. But that tells us it's an investment in bonds for this company. It's an asset on our books. We need to increase the value. Now, don't go in here and hit 1.6 million. You're going to only hit 300,000. You're already carrying this asset at 1.3. You need to just simply mark it up to that new fair value. Keep in mind, if you're carrying it at amortized cost, you'd have to take into account any discount accounts and everything to get that. So just make sure you take it from your amortized cost, what you have it on your books, and in our understanding it's 1.3, up to the fair value, or down. If it lost value, then you'd write it down, but in this case it increased value. Now what are we going to credit? Well, we're going to hit a gain. We have to show this on our books that it was a gain to our company. Now we do this on the date of declaration. If the value of those bonds change afterwards, we don't really adjust that. We simply carry it. Once we declare it, it's as if we have gotten rid of that asset. We know we no longer technically own it because once we declare that, we have to give it out. So that investment will go up to 3. We'll go ahead and recognize that gain on the change in value there. All right. Now, what else do we need to do? Well, now we need to show that we're paying it out in a dividend. Okay. But we haven't paid it yet. So now what's a dividend? Well, it's an allocation of earnings. So we're going to hit retained earnings for the dividend. And that's going to be the full fair value of the asset. We're going to go ahead and show that at 1.6. And then we're going to go in and we're going to hit our property dividends payable, just like we did cash. But in this case, we're not using cash. We're actually using a property dividend account. Now keep in mind, my names may be slightly different from the textbook you use, but it's the same overall concept. Now March 13th rolls around. What are we going to do? Well, that's the date of record, and it is no entry. Dates of records we typically do not have any entries on unless we made a mistake and need to correct it, but that's not typically going to be the case. So we're going to hit no entry required there, and then we're going to go to the date of distribution. What do we do on the date of distribution? On the date of distribution, we go in and, again, just like a cash dividend, we get rid of the property dividend. We're actually paying it out on that day. So date of declaration, you create the payable in this case. Date of payment or distribution, you get rid of the payable. Now, what are we giving our shareholders, We're giving our shareholders those actual bonds. So once we give them out, we no longer have them on our books. So we're going to hit the investment in Warner bonds that we had before for the full 1.6. We're just like the cash, we got rid of the asset. We're removing it from our books. All right. So we've gone over cash dividends, we've gone over property dividends and how to record those. Let's look at the next transaction and see what we need to do. On July 12th, That is where we're at, right? July 12th? Yes, it is. Awesome. So on July 12th, the corporation declared and distributed a 5% common stock dividend. Well, imagine that. We said there's three types, and lo and behold, this problem goes over all three types. Just imagine that's a miracle. But anyway, on July 12, 2019, the corporation declared and distributed a 5% common stock dividend when the market value of the common stock was $21 per share. Cash was paid in lieu of fractional shares, representing 250,000 equivalent whole shares. Now, let me just quickly explain what a stock dividend is. So basically, what a stock dividend is, let's say you owned 100 shares of stock. When this company goes and declares a 5% stock dividend, what they're going to do is they're going to take that 100 shares that you owned before, they're going to multiply it by that 5%, and they're going to come out and say, hey, we owe you 5 more shares. So when it's all said and done, I'm going to give you 5 additional shares. You did nothing to earn them, just simply were an owner in my company. Now, that's fine and clear. That 100 shares was a nice even 5 shares. Now, what if you were an owner and you owed 285 shares of stock? So let's go in and say, hey, 285, and you're going to give me a 5% stock dividend. How many shares, whoops, that's supposed to be a multiplication. How many shares is the company going to have to give me? Since I had 285, I didn't have just 5 shares. So 285 times our 5%, that's 14.25. Now here's the problem. Can I give an individual a fourth of a share of stock? The answer to that question is no. We can't take a share shock, listen to me, can't take a share of stock and rip off a fourth of it and hand it to someone. That's not how it works. So what can I do? Well, I can give them 14 shares and then I pay them cash for the 0.25 shares. So here, when it says we have cash and paid in lieu of fractional shares, that's what they mean. We have several shareholders that have this situation where they have 285 shares times 5%. I can only give them 14 shares. So that means I have to give them cash for that remaining 0.25 or 1/4 of a share of stock because we can't split a single share of stock that way. So that's what it means. So if we take that 105 million shares that they've got and multiply it by 0.05, that comes out, excuse me, that comes out and gives us a nice even 5.25. Okay? Now that's 5,250,000 shares. But what they're telling us is, hey, we can only give out 5 million shares, and those 250,000 shares were fractional. So instead of giving them actual fractional. And so instead of giving them 250,000 shares, it's not possible for us to split those shares up properly. We're going to give them cash instead. Okay, so this is going to be a unique situation, but let's talk about this stock dividend first and foremost. We know we're doing 5.25, 5,250,000 shares. So let me just write this out. That's the number of shares we're actually giving out. Except 250,000 of them were fractional shares. So that leaves us 5 million. So when we go in to record this, we're going to first off hit our retained earnings. Just like any dividend, we're actually giving out earnings to our owners. Now, when we do that, we're going to record this at the market price because that's the value of the stock that we had when we gave it out. So we're going to take that $21 and we're going to multiply it times the total number of shares. Okay, 5,250,000. We do that, we get 110,250. Now, when we give out shares of stock, the next thing we're going to do is we're actually giving out common stock. Now, be careful here. How many shares of stock are we actually giving out? Well, remember, 250,000 of those were equivalent shares, fractional shares, I mean. So of that, only 5 million of them are shares that we can give out. The par value on our stock is $1, so we're going to hit our common stock for 5 million. Now, some will put it in like a distributable account and then later on the date of record hand them out. But a lot of texts will show that we just hit common stock. So that's what we're going to do here. We're going to hit the common stock account at par for that amount. Now, how much goes in paid in capital? Well, paid in capital in excess of par. Remember, I call that PICIT. So again, my students can abbreviate that. If you're watching this from afar, then please use whatever your professor says you can use. But anyway, so PICIT on our common stock. Now, how are we going to get that? Well, think about it. We're giving out 5 million shares, not 5,200,000. And then it's going to add $20 per share because it's 21 minus the 1. That leaves me $20. Multiply that by the 5 million shares I'm actually giving out. So that's going to bring us to 100 million. Okay. Now there's a slight difference here. What is it? Well, it's the 250,000 shares that we're paying out in cash. Okay. So now, how do we find that amount? Well, remember it said 250,000 fractional shares we're going to pay it out in cash. So those 250,000 fractionals times $21. Now I can split $1, so that's pretty cool into pennies. So when we multiply that out, we get 5,250,000. Okay. So remember, retained earnings, you're always going to take the total number of shares that you would be giving out times the market value of the stock. So 5,250,000 times 21, that's 110,250. Then we hit our common stock for all the whole shares that we can actually give out as shares of stock. We cannot give out a fractional share, so these are the whole shares. So I can give out 5 million whole shares times par value gives us 5 million. And then our PICIP will go in at whatever those 5 million shares are above par. So notice we have a $1 par. We have a $21 market. So that means it's $20 above par times the number of shares we physically can hand out, which is 5 million. That gives us 100 million. Then the fractional shares have to be taken into account because we have to pay those out in cash. We cannot give out fractional shares. We said 250,000 shares in total were fractional shares. I multiply that by the market value of 21, and that gives me the 5,250,000 that I have to pay out in cash. So now we should balance out nice and neat. All right. Any questions so far? Now let's look at the next transaction. On November 1st, the board of directors declared a cash dividend of 80 cents per share on its common shares payable to shareholders of record November 15th to be paid December 1st. So now this is a little bit tricky. Keep in mind we pay dividends on outstanding shares of stock. Well, a lot of people make the mistake here and they throw 105 million. But the entries are basically the same as before. This is a cash dividend, so we're going to hit retained earnings and we're going to hit our cash dividends payable. Then on November 15th, there's going to be no entry required. And then December 1st, just like before, we're going to hit our cash dividends payable. And we're going to pay it out in cash. Now the question becomes how much? Well, a lot of people say, oh, it's the same as before. It's 84 million. So they go and start typing 84 million. But no, remember, dividends are always declared on outstanding shares. We had 105 million outstanding shares, but notice, what did we do? Well, that was 105 here, but we went down here and had a stock dividend, and how many more shares did we give out? 5 million more, okay? So that's 105 plus 5. So at this moment in time, we have 110 million shares outstanding times that 80 cents. So it's going to change our answer just a little bit. So instead of 84, we're going to come up with 88. So be careful when you pay out or declare a dividend. It's the number of shares that are outstanding at that point in time. So you have to take into account any new issuances that you did between the beginning of the year and the date of declaration. Now, when we go to pay it out, of course, we simply pay out the 88 million. Okay. So entries are exactly the same as the first cash dividend that we did. The only difference is be really careful. You have to make sure you include all outstanding shares at the time of declaration. Okay? All right. Moving on January 15th, the board of directors declared and distributed a 3-for-2 stock split effected in the form of a 50% stock dividend. Now, sometimes you just have a stock split, and sometimes you have it effected in the form of a stock dividend, which really creates a journal. Typically, a stock split, say you have a stock split of 2-for-1. they do not impact the financial position of the company, because what happens is, yes, we give out more shares of stock, but the pars then split. So let's say you have 100 shares at a dollar par. If you did a 2-for-1 stock split, you would give everybody an additional share. So you'd have 200 shares, but the par would go down to 50 cents. So it would not impact our entries. But if you have a stock split that's stock split that's affected as a large stock dividend, it does impact our books. So basically, how do we treat that? Well, it's slightly different than a traditional stock dividend. When we go in to hit this, we do not have to worry about retained earnings. We're not actually giving out retained earnings. We're simply going to take away from our PISIP on our common shares, and we're going to issue out the common stock. So a stock split affected as a stock dividend, you simply basically reclass paid in capital in excess of par, and you reclass it into the common stock. Well, how much? Well, first off, you have to figure out how many shares are we giving out. Well, we have 110 at this moment in time, and we're effectively giving out a 50% stock dividend. So 110 times 50% gives us 55. Then we multiply that by the $1 par. And when we do that, we get 55 million. So notice this is a little bit different than an actual stock dividend. So when we do a stock split effective as a stock dividend, what you're going to do is you reallocate it out of PISIP and you move it into common stock. In other words, you're saying that your owners didn't pay quite as much over par as originally recorded. And then we give them the shares of stock. So we're actually going to give out the 55 million shares. So we hit our common stock account for the 55 million. Okay, that's dollar par. So notice the difference. There's a little bit of a difference. When you actually do a stock dividend, you're actually allocating earnings and giving those in the form of stock. When you do a stock split effective as a large stock dividend, you move it from PISIP. You're going to debit your PISIP account and you're going to credit your common stock. Okay, so it's basically a reallocation process. All right, now the last one is going to be another cash dividend. It says on November 1st, the board of directors declared a cash dividend of 65 cents per share of its common shares, payable to shareholders record November 15th, paid December 1st. So it appears every year we do these. So November 1st, again, is our date of declaration, and December 1st, our date of distribution. November 15th, again, is the date of record. So when are we going to do the entries? Well, it's a cash dividend. So anytime we do cash dividends, we're going to hit retained earnings. And we're going to credit cash dividends payable on the date of declaration. Remember, date of record, there's no entry. So we'll just go ahead and put that. And then on the date of payment, we're going to hit cash dividends payable. And we're going to pay this out in cash. Now, pause the video and see if you can come up with how much. Hopefully you paused it and this is what you came up with. Well, remember we had 105 to start this period. Then we issued the 5, which brought us to the 110. Then we did a stock split effective as a stock dividend, and that additionally issued 55 more. So at this point in time, we have outstanding 165 million shares. Okay? So put that in there. And then we multiply that by the 0.65 times 0.65. And that's going to give us a lovely, hold on, let me get my calculator. Hold on, what did I hit wrong? 165 times 0.65. There we go. Gives me a lovely 107,250,000. Okay. So keep in mind that's the number of shares we've got outstanding as of that date. So that's the dollar amount. So hopefully that's what you came up with when you did your calculation. All right, I know this has been a long video going over how to do different types of journal entries for different types of dividends. So I hope this has been helpful in realizing how you would record each of those different types of transactions.